Today we're digging into an analysis on Reviva Pharmaceuticals, RVPH.
Mm-hmm.
The core argument is that its recent stock drop down around 63 cents is a huge bear trap,
Right.
especially when you look at the Q3 earnings beat and some of these pretty high analyst price targets. So let's just get right into the critique.
Sounds good.
We're starting with a big picture item. The highly energetic and heavily bullish tone currently risks sacrificing analytical credibility for promotional urgency.
Okay.
I mean, the report is explicitly framed with high energy, uses phrases like do not sleep, talks about explosion potential, and really leans on that bear trap concept. You can tell the conviction is there.
That passion is undeniable. And look, for a microcap stock that has been absolutely hammered.
Right. You need that conviction just to cut through the noise. I wonder, though, if we've maybe considered the audience here, a sophisticated reader looking at this kind of deep dive.
Yeah.
The excitement is great, but that reliance on sensational language, like calling the price absolutely ridiculous in hindsight, it might actually trigger some skepticism.
That's a really sharp point. I mean, when a stock is trading at 63 cents, the first reaction from an experienced investor isn't, wow, what a bargain.
No, it's what am I missing?
Exactly. What's the hidden risk here?
Precisely. The goal is to prove that the market's bearish bias is unjustified by the data, not to just sort of override that bias with enthusiasm.
Right.
If the tone feels more like promotion than, objective due diligence, you might lose the reader right away, no matter how good the Q3 numbers are.
So it sounds like we need to inject just a little more humility, maybe, to support these massive targets. I mean, some are up to $16.
I think so.
How do we keep that bullish conviction but ground it more in the numbers?
My advice would be to just recalibrate the language. Lean more on conditional probability. That strengthens the report's integrity, It shows the reader the analysis is sound and calculated, not just an exciting idea.
Okay, so let's get concrete. The analysis says, pretty aggressively, do not sleep on this stock. What's a better way to frame that?
Well, instead of that command, you could frame the takeaway as something that comes directly from the data.
Like what?
Something like the current disconnect between the Q3 fundamentals, especially that EPS beat, -6 cents versus an expected -10, and the price presents a significant data-driven entry point. It just shifts the focus from an alert to an observation.
I like that. And what about where it dismisses the short case? It says, here's the math that the bears are ignoring.
Yeah, that phrasing, it kind of implies the bears are just ignorant, which probably isn't true.
Right. They're just weighing the risks differently?
Exactly. A more robust way to do it would be to frame the whole thing as an anomaly. Something like it's an anomaly requiring closer examination of the risk-adjusted targets. That way you acknowledge the bear case exists before you just dismantle it with the financials.
So you address the skeptic head-on?
You do, and by doing that, your bullish conclusion ends up carrying way more weight. It's calculated conviction.
That makes sense. Okay, so that first point deals a lot with credibility. But speaking of high risk, I felt the report waited way too long to talk about the elephant in the room.
The clinical trial outcome.
The binary risk, yeah. While the analysis correctly identifies the binary nature of biotech, delaying the introduction of this crucial clinical risk until the conclusion, it just weakens the whole logical structure.
I absolutely agree. The structure here is a huge opportunity for improvement. It almost diminishes the very thesis it's trying to build, that asymmetric risk-reward.
Right, because if I trace the flow, it establishes financial strength first, the Q3 beat slashing the net loss, that $13.2 million cash runway into 2026.
All good things.
All good things. Then it jumps to the catalyst, talks valuation, and only at the very end does it mention, oh, by the way, biotech is binary and high risk.
And for a microcap at 63 cents, the pipeline risk, the outcome of that Recover Phase 3 trial, that's everything. That is the primary driver of valuation.
Of course.
The market is pricing the drug, not the G&A savings. So structuring the report to treat that risk like an afterthought, it almost feels like you're trying to downplay it. It feels less objective.
So what you're saying is that good financials in biotech, they aren't the reward. They're just a tool.
Exactly.
We need to be clear about what that cash runway buys an investor.
That's it. That $13 million in cash, that runway into 2026, that's a strategic asset. It's a remarkable piece of stability for a company in this position. But if you just mention it without context, it loses its power.
So what's the suggestion?
The suggestion is to introduce the specific clinical risk right after you establish that financial stability.
Okay.
Use the good financials as the safety net, the time buffer that makes taking this very specific clinical risk a smart bet. That is how you truly define asymmetric risk-reward.
It reframes the whole question. It goes from, is this stock cheap, to, is this stock worth the gamble, given it now has the time and money to see it through?
Exactly. A much more powerful frame.
So how would that look structurally?
It would be a very clear transition. After you conclude that the cash runway removes the immediate fear of bankruptcy, the very next sentence has to pivot.
Okay.
You could say something like, this financial stability allows the company the necessary time into 2026 to execute on the primary driver of its valuation, the binary outcome of the RE cover Phase 3 trial extensions for brilaroxazine. This is a high-stakes moment, and here is why the market seems to be overpricing the probability of failure.
I see. So you put the risk right up front, and then you use the financials to mitigate the survival part of that risk. The whole argument just becomes so much more mature, more logical.
It gives the reader confidence that you're dealing with reality, not just hype.
Okay, so if we fix the structure and put the risk first, we then move on to the product itself. We know brilaroxazine is targeting huge markets, but is that enough to justify an 800% move?
The discussion of the lead candidate, brilaroxazine, requires more specific contextualization to justify its explosion potential beyond just saying it targets multi-billion-dollar markets.
This is the core issue for justifying that huge valuation jump. If the analysis can't define what makes this drug unique, then the high price targets just look like pure speculation based on the TAM.
Which is a classic trap in biotech analysis.
A huge one. So let's look at what the report says. It notes brilaroxazine targets schizophrenia and psoriasis, huge markets, and we're waiting for data from the RECOVER Phase 3 extensions.
Yeah, that's accurate, but it's table stakes. Stating the market size doesn't differentiate RVPH from any other developmental biotech. The report doesn't give a specific reason why this drug is expected to succeed. What's the unmet need? What's the competitive advantage?
And without that, the whole investment case feels a little shaky. Especially for a microcap where if this drug hits, it's massive, but if it fails...
It's toast. Yeah. To justify explosion potential, you have to anchor it in something more concrete than just a big market.
So what's the suggestion here? How do we fix it?
It's actually pretty simple. You have to bolster the argument by grounding the drug's potential in its unique competitive position. We need to know what specific high-value outcome the RECOVER trials are supposed to confirm.
So connecting the clinical outcome directly to market adoption. Is it a different mechanism of action? Does it have fewer side effects? What is the clinical value proposition?
Exactly. Especially in a field like schizophrenia, side effect profiles are often the primary driver of market share, even more than raw efficacy.
Right.
Existing antipsychotics can cause awful issues, like major weight gain, metabolic syndrome. If brilaroxazine has a cleaner profile there, that is the key. That specific detail is what justifies the exponential potential.
I see. So instead of generalizing, we need to explicitly connect the clinical outcome to the market opportunity. Can you give us an example of how that would look?
Sure. Instead of being general, you could get specific. Something like, if the RECOVER extension data reinforces the drug's profile for, say, substantially reducing the rate of weight gain, a common debilitating side effect of current antipsychotics. This validates the high analyst targets. This competitive advantage is the specific mechanism justifying a substantial repricing.
That links the clinical utility directly to the valuation. It makes the case so much more bulletproof. It shows you understand the competitive landscape, not just the balance sheet.
It gives the reader confidence that this isn't just a lottery ticket. It's a high-risk play, yes, but one based on a real differentiating factor.
Okay, that brings us to the end of this critique.